Hello, Jeffrey Kerr, Kerr Financial Group. Today is August 13, 2021, Friday the 13th, and we'll try not to get too superstitious. All black cats been removed from the office, I think. Mirror's gone, so we won't break any of those, and not going to walk under any ladders as well. So, but today's topic is going to be the jobs market and the employment data that was reported last Friday. The Labor Department estimated that 943 new jobs were in July. That was much more than forecast, which is a good thing. Another good thing is that the prior month's revisions were upside. So the prior June and May were revised higher, and revisions are given a lot of consideration as well. And the unemployment rate fell 0.5% to 5.4%. Huge drop in the unemployment rate. So good news. And of course, the stock market reacted well. S&P and Dow Jones Industrial both closed at record highs on Friday. The S&P, Dow, and Nasdaq Composite all were up about 1% last week, and that's to be expected. Strong jobs market, it means that more people are working and earning a paycheck, which then oftentimes you see them spend it, clothes, shoes, cell phones, televisions, appliances, cars, homes. People take vacations. They go out to dinner and concerts and theaters. So all these activities contribute to a stronger economy, and it kind of starts with one of the factors it starts with is the jobs market. And the other thing to consider out of this is that the direction. So in all statistics, are things improving or are they deteriorating? And so that's one part of it. And this jobs number certainly points towards improvement. And so that would be one part of it, that there's improvement in the numbers and hence the economy. But the other part of the statistical analysis is, at what rate are things improving and deteriorating, and the rate of change. And this would indicate that the rate of change will stay high. The rate of change is that not only are things improving or deteriorating, but at what rate. So it's not necessarily just a linear improvement, but more of a curved improvement or accelerating deterioration or whatever. And those rate of change numbers are watched, by the economists and strategists as well to predict, what's going to happen in the future and also point towards inflection points. I think one of the things prior to last week's employment report was worry that the rate of change and the improvement over the third and fourth quarters of 2020 would be challenging, and that the second quarter 2021 was a layup to improve over what was shut down in the second quarter of 2020. So the third and fourth quarters of 2020, when things started opening up a little bit, the as we look forward to the third and fourth quarters of 2021, will they be able to improve, and will the rate of change be strong or continue to be positive? And the jobs number is the first indication that this might happen. So if we get this, a continued things going, improving, but also the rate of change still staying strong, the markets are going to do pretty well in the third and fourth quarter. But I mean, it remains to be seen. This is one data point. We've just got to watch it. And I'll be, trying to keep an eye on these things as well as other things. So, if there's any questions on this or any further explanation, reach out to me. I think the one negative out of this and is, what does the Fed do? As the economy stays strong, how does the Fed react? So that's something to be mindful of too. I'm not sure if the Fed is superstitious or whether they have any black cats in their building, but wish them a lot of luck in dealing with these issues. Thank you for tuning in. Again, reach out to me with questions, comments, suggestions. We welcome them. And so again, thank you and talk soon.